Depending on the age you are and how you invest is always a question that people have. Trying to nail down the proper asset allocation or basket of stocks versus bonds versus cash in a portfolio, depending on your age. There's a rule of thumb that's out there, and so it's if you take 100 and then you subtract your age, so let's just say you're 60, well, that would mean then that you would need 40% in stocks. The problem with that is, what if you're 20 years old? Well, at 20 years old, that would show that you would need 80% in stocks. Well, we've oftentimes heard the younger you are, the more aggressive you should be. And that's oftentimes the case. But let's really break this down. Let's take a look. I'm going to show you multiple different companies and what they've put together, as well as something that we use here to help with financial planning with clients at Jazz Wealth. So let's just break this down a bit. So first, this is an awesome map to really start to show you just what you're looking at when it comes to returns. This is something that Vanguard themselves had put out. And so if we're looking here, this is from 1926 to 2022. As you can see on the bottom, there's the data there where they're getting their actual numbers from. But if you were in 100% stocks on average from 1926 through 2022, you would have an average return of 5.1%. Now, there is going to be some big ups and some big downs from there, but that is going to be the average. Then we go all the way over to zero bonds and 100% stocks, and it's 10.2%. Now, one thing that you've got to be careful of, though, is really finding the time that you invest in the markets. Because if you started in the markets in 2000 through 2010, you started in the dot-com bubble, then we had the World Trade Center attack, then we had the global market crisis of 2008, and all of that would have basically put you at close to a net of a zero on your returns. So you have to really start to figure on when you're looking at when it comes to timing. You have people like Dave Ramsey who talks about getting a 12% return, but again, you have to look at the time frame that you're looking at. If you looked at from 2010 until today's date, 2024, well, you would probably have much higher returns than even what this chart is showing you with Vanguard. So that's just giving you a base breakdown of looking at the different allocations and how this could work. So this one here is actually a really nice, just clean chart that talks about asset allocation. This is from T. Rowe Price, and it shows when you're 20s, your equity should be 90 to 100%. Remember, equities is the stocks, so that's investing in the stock market. Sometimes people just like to buy like an ETF or something that tracks the S&P 500 or an index fund. Then you have in your 30s, 90 to 100%, again, showing you to be more aggressive. But then in your 40s, it's showing, well, 80 to 100%, and then fixed income 0 to 20. Now, again, at least they're giving you a broad range there, and they're not saying, hey, this is what it should be or what it should not be. It's giving you a little bit of a buffer there. Then you've got your 50s, 65 to 85% equities, 60s, 45 to 65, 70s and older, 30 to 50. So this is really breaking down what they're thinking you should be at based on your asset allocation. And oftentimes, this is just a recommendation from these companies because they're not actually knowing you specifically. And that's something I really want to make sure that we're talking about, because it really does depend on your goals. And now Charles Schwab does a good idea of breaking this, or a good job of breaking this down, because they actually just put together this chart here that talks about your risk tolerance. Is your risk tolerance high, moderate, or low? And if it's high, well, then your investment objective is aggressive growth, so it would be a lot more stocks. In your time horizon here, though, because oftentimes time horizon does come into play when it's talking about how you are going to build out your portfolio. If you're 20 years old and you're investing for buying a home in 5 years, well, guess what? You may not want to be 100% in the stock market just due to the fact that the volatility that comes into play there and the pullbacks that could happen, you may not have the money that you started with, depending on where you are in the markets and how the markets go. And so looking here, that's saying with the Charles Schwab chart here is that 15 years time horizon, or 15 plus, is an aggressive portfolio, 95% stocks, 5% cash. Give or take, again, this is kind of just a base recommendation or an idea of what they're giving you. Risk tolerance of moderate, around 10 years is the length of time there, and then conservative, 3 to 5 years. So what's cool with this chart, though, and something that we do with a lot of our clients here at Jazz, is that we actually start talking about buckets. Because if you're retired, you could have some money that is short-term money that you maybe aren't taking as much risk with, but other money that's continuing to grow. And that will all depend on your financial plan and what that looks like. And also, it will depend on your comfort level of the markets, and then as well as how much money you need to have or how much risk you need to take. What we've seen oftentimes is somebody that has a $1 million portfolio, they tend to get a little less aggressive just because when the pullback happens, it just seems to hurt more. If you have a 30% pullback in the markets and you're 100% on the equity side or in the stocks, and you have $1 million portfolio, well, now when you open up your account, you have $700,000. And to people that have a lot of money, that hurts. I mean, I'm not saying that if you only have 10,000 and you lose 30%, it still hurts to open up and have 7,000, but you lost or what you feel as though, if you don't sell off, you may not lose it at the time, but you feel as though you lost $3,000. But on the other side, for the person that has $1 million, they feel as though they lost $300,000. It's a bit more of a hit and some chest pains that can come into play. So let's just take a look here at NestEgg and something that we use here with clients at Jazz, and to show you and break this down. And so if we're looking at the current allocation is showing you a 90% stocks, 10% bonds. With that current allocation as we're looking at, what we're showing here is an annual return of 8.8%, a little less growth showing than what we saw on the Vanguard chart, which is okay though. We want to actually plan for a little bit more conservative. Now, this is an aggressive growth portfolio is the way this is broken down. Standard deviation there, which means basically it's looking at pretty much the average from how much it's falling. So if we're looking at the baseline of 0, how much is the average that it's falling? It could fall there is about 14.8%. There's definitely been more times in the markets where it's fallen farther than that, and a lot less than that. But that's what you can kind of predict on times of saying, okay, if I'm going to invest here, it's a good possibility that I may see some 14.8% pullbacks over time. Now, if we want to break this down, we can look at a preservation portfolio. And on that preservation portfolio, you're looking at an annual return of 4.1%, standard deviation of 4.8%. So you've got to remember though, 4.1%. You're like, well, hey, you know what? I'd rather do that and not really have my money go around too much. That's okay if you don't need a lot of risk, but you're also not going to keep up much past inflation. If inflation's at 2 or 3%, you're only getting 4.1%. That's kind of a challenge there. And if you're working with an advisor, oftentimes advisors, depending on the advisor you're with, are charging a fee of at least 1%. At Jazz, we're not charging that much of a fee as long as you have over a certain limit. We have our breakdowns on our website. You can always check out if you want to. But if we're looking here at the target allocation of conservative, you can see annual returns of 5.2%, and then it continues to go up to the most aggressive is where we were at. Now, let's take a look, though, at a portfolio and kind of show you exactly how this would look for this person. So this person has $400,000 that's invested. They're going to be getting Social Security, but they're 65 years old and they're retired. It's retired Roger and Mrs. Retired Roger. But look at the difference here. In this plan, if they take more risk, most aggressive here, that's actually going to provide them a higher probability of success on living on $6,000 a month in their plan than if they only had they would have a 47% by going with more of a 50-50 balanced plan. And so why I wanted to show you that was really just to break down the differences on what you may need, because in your specific scenario, you may need more risk than what you're actually looking at with just a general chart. On the other side of that, if you have surplus of money, you may not need to take as much risk as even what it's showing you at your age. So it's something of finding the balance, finding your risk tolerance. It all depends on you. But if you want to check out somebody and talk to somebody, there's plenty of financial planners out there, and I know of a good one.